the ISM and how it works, you can then find things that lead it. So that gives you an ability to forecast, okay, what it looks like. So currently I'm using a mix of the rise in interest rates, the rise in commodities, and the rise in the dollar. And it's like financial conditions. And that's suggesting that the economic cycle goes almost immediately to recession and pretty sharp. And I think a lot of people are sensing that is happening. You're hearing it from companies, you're hearing it from a lot of people to say, yeah, looks like we're going to recession. So the forward-looking stuff suggests we're about to go into a severe recession. So now you need to figure out, well, what are asset prices pricing in already? Because you can't trade on today's news. You need to trade on tomorrow's news. And really speaking, you need to trade 6 months out news. So if I look at the year-on-year rate of change that I talked about, if I look at the S&P 500, it's already pricing in about 42 in the ISM, so a full recession below that 47 level. Could it go a bit further lower? Yes, because my forward-looking indicators suggest the ISM could get down to 40 or so, maybe a bit lower. But we're kind of in the right zone to say, actually, a lot's been priced in. Could there be one leg lower? Maybe. But that means that as an investor, your spidey sense should be up saying, hey, is the opportunity coming here to buy when everybody else is fearful? So again, my forward-looking indicators suggest that the economy picks up maybe in the first quarter of next year. So in which case the markets will start to forward look some of this. So it's actually a little bit of a tricky point in time today, but we're getting very close to the time where the markets will start saying, okay, I can see what's going to happen here. The economy's going to go into recession. The Federal Reserve will stop raising interest rates, as will the other central banks. And chances are things start reversing. Really, he who has cash in a recession is king. Because you want to be ready when nobody else is, when everybody's being forced to throw all their trades out and stop themselves out from losing money. You want to be able to buy. So you kind of want to have cash ready, and then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take advantage of the sell-off in crypto and the sell-off in stock markets and technology stocks, because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. You don't want to take as much risk because you don't have an income. So your grandparents don't have an income anymore, so it's just their pension. So they need to be careful, very careful with their pension. Their nest egg has to be protected at all costs. If you're young, the single best risk reward is crypto, because it's the only market that goes up 10, 20, 50x, while the stock market may go up 200% over the next 5 years, but crypto market does a lot more. So if your aim is to take risks to accumulate wealth, then crypto. I prefer crypto as a bet because I think it has a better risk reward than other markets. But you have to suffer these drawdowns, and a lot of crypto is down 60, 65%. But if you're less risk seeking, you might just want to buy equities. If you're slightly more risk seeking in equities, you might want to buy technology stocks, because technology is not going away. I mean, the rise of everything from AI to robotics to EV to space travel to everything is all happening at the same time. We've got this huge inflection point. So clearly that's going to be something that's probably going to generate a lot of profits over time. So I think it depends where you want to be on the risk curve. Some people like physical things, so they like to own stuff like oil companies, because there's not enough oil being produced currently for world demand. So maybe over the next 2 or 3 years that does well, but those stocks tend to be mean reverting, i.e. they kind of just go in cycles. They're not the buy and hold that technology can be or crypto can be. So I prefer technology and crypto overall. All of my savings that I don't need to cover my bills is in crypto. And I've been adding because we're at that point where the economic inflection point is going to change, and that tends to be quite good for crypto. So I don't expect everybody to do that, because liquid net worth is different to entire net worth. I've got houses, that I don't have mortgages on, I have an income. So the amount of risk I'm taking is actually not as big as it sounds. And first time around 2013, it was significantly less because it was riskier. We didn't know, was this technology going to survive? Was it going to be banned? All of the questions that have now mainly been resolved. We didn't know that back then. It's like, here's a bet. I think I wrote the first ever macro strategy piece on Bitcoin in 2013. And I said, it was $200 at the time. I said, listen, if we value it like gold, it could be worth $1 million. So let's assume I'm an idiot and discount myself by 90%, still worth 100 grand. And therefore at $200 with the upside, you could lose all your money, but the upside was 100,000. I'm like, this is the best risk reward I've ever seen in my entire life and the best one any of us will ever be given. And that actually proved out to be the case. The hard thing about the crypto ecosystem is there is so much happening all at the same time. I mean, they've just raised $60 billion in venture capital and everybody's building out projects, whether it's lending markets, financial markets on DeFi, whether it's putting traditional financial markets onto blockchain rails, whether it's putting real estate onto blockchain, whether it's doing really interesting things with NFTs such as ticketing. So we're seeing Ticketmaster has issued 10 million NFTs, the largest NFT issuer in the world. That's going on. We've seen Solana building a phone which integrates all Web3 in your wallets. You've seen, I mean, there's literally almost too much to keep on top of. So, how do you pass through all of that excessive information? You start looking, okay, what are the main chains that the activity takes place on? And the main place is Ethereum, and then places like Solana, Avalanche, Polkadot, and a few others. So that's how you kind of filter down. You see all of this stuff going on. You're like, oh, this is overwhelming. But then the great thing is what platforms they're being built on, and then we can invest in the underlying platforms and projects. When I bought Bitcoin in 2013, I was super early. I had a long-term thesis, and I knew it was going to be volatile and it could go to zero. So the idea was, I bought it. It went up from 200 to 1,000 in 6 weeks. I'm like, oh my God, I've never had something do this before. Then it fell 87%. And I kind of like, fine, I knew it could go to zero, but I think it's got a much bigger upside. And my thesis was 100,000 up to 1 million. And then it kind of did nothing for a while and then took off. And there were the forking wars happened in Bitcoin back in 2017. And I got confused and worried that, okay, I don't know what this is going to mean. Is this all going to fall apart? And I was now up 10 times my money. So I took profits and I felt like a god. And then it went up another 10 times. And I was like, that's okay. I've made 10 times my money. I can't argue. Then it crashed again. And I eventually knew that crypto, and particularly Bitcoin at the time, and macro would merge in the next recession. And that I really wanted to own it when it got sold off in a recession. 2020 comes along and I really piled in with as much money as I could possibly scrape together. And it turned out to be a phenomenal bet. Okay, so that sounds amazing. I went back and realized if I'd have just kept my initial investment and not done anything else, I'd have made 5 times as much as I did by trading it. And then I worked out one more piece of magic, which was if I'd actually bought crypto every time it did these big sell-offs and just added to my position in the same size I had originally put on, I'd have made 25 times as much money. So here I thought I'd done it really well. But what I screwed up was time horizon, because I knew it was going to be a long-term time horizon, and I ended up trading shorter term. And on paper, it looked like I was a genius. But the reality was I was a fool. And so that was a huge lesson for me, both good and bad.